first step in building an investment portfolio and building your investment strategy is to make sure that you have got good research. We use a research provider who has over 5,000 employees across 27 countries, and they actually look after and monitor over 600,000 investments, and they provide information to us on a daily basis that affords us the opportunity to make really good decisions on behalf of our clients. The principle that I'm about to introduce to you from an investment perspective is really a fundamental of investments. How investments work. The graph that you've got on the screen in front of you shows a chart that identifies fair value relative to the price of a different investment. To give you an example of how this really works, I think most investors in Australia understand property, so I'm going to use property as an example here. What you'll see is that there's a red line that's called the fair value line. That is the line that represents what the market perceives is the fair value of an investment. For example, you were looking to buy an investment property. It is the market value of the property that you're hoping to buy. That's called fair value. When you go to buy this investment property, if this is what you are choosing to do, your objective is to try and buy the property for something that is less than fair value, because that means you know you've got a good deal. It is likely that the person who's trying to sell the property is trying to sell it for more than fair value. And so what you'll find in financial markets, whether it be buying and selling properties or buying and selling shares or buying and selling any securities for that matter, there is a place in the market called fair value, and you've got buyers and sellers that are always looking to make investment decisions for themselves that play to their advantage. And so buyers are always looking to buy things a little bit more cheaply, and sellers are always looking to make a profit. What you find here is a graph that shows you, in principle, when it's a good time to buy, when it's a good time to sell relative to fair value. And you can also see a line there that we've got which is called a margin of safety, and the margin of safety is normally where we'd be making investment transaction decisions to buy or sell. And I'm going to take you through a real live example of how this works and why, how we would make some investment decisions for clients, and also what it really looks like to move in and out of markets and build an investment portfolio so that you can see how it may work in retirement. At the bottom of the dip in performance, what you'll have is a position here which is called the best time to invest because it has the greatest potential for returns. There's also the lowest potential for losses. So if you've got investments that are going backwards and you happen to buy something down here, whatever you buy is probably going to go backwards less in value than people that have bought securities valued up here, because there's a lot of room for the downside movement there. Clearly, from an investment perspective, all buyers are looking to get in here, but then the question also becomes, when do you get out? So do you get out here? Do you get out here? Do you actually get out at the top or the bottom or in the middle, and why? So this is what we're going to talk you through. This is a real life example of what we did for a client who came to us 3 months ago, and they wanted to buy an Australian equities portfolio. And so we used our research, and with the research what we did is we identified a portfolio of securities that were appropriate for them based on different types of ratings from our investment research house. We identified which of those investments were going to provide the biggest returns, and you can see that we've highlighted 4 securities here: Ainsworth Automotive Holdings Group, Pendal Group and Platinum, as the different investments that we perceive are going to make the biggest returns and have the greatest percentage uplift to fair value of the securities that we've been reviewing. Now, just so you know, when we did our research, we actually filtered over 2,000 investments in order to identify this short list of 15 odd securities for the client. Our research systems, and this is where research becomes value, affords us the opportunity to analyse stocks. So step one is to choose your stocks, and most people that are investing based on fair value principles will be looking for investments where there is a significant uplift to fair value. And what that means is that you're actually trying to find the stocks that have got the biggest potential and the biggest upside relative to risk. We make the investment decisions, we weight the investment decisions for our client based on how much uplift to fair value we believe is real in the market. What you'll see here is that with Ainsworth, we're just going to look at these 4 stocks because they've got the most upside. We're looking at Ainsworth, and we've given a weighting of 9% of the 100% of the portfolio to that. We've then looked at Automotive Holdings Group, and we've given an 11% exposure to AHG. We've looked at Pendal Group, which is at 9%, and Platinum Asset Management, which is at 8%. Those top 4 stocks actually represent 37% of our investors' portfolio. What we're trying to do is help our investor make sure that they get good returns reliably over time, but also without taking on too much risk, because when you put in play investments that have got a lot of upside to fair value, then what you're really also saying in some ways is that your research analysts think that there's not much more downside in the stock. Not always the case, but certainly from a research principles perspective, this is how we look at it. So let's have a look at how this investment portfolio went. Let's have a look. What we'll see is that Ainsworth has increased in value by 3.85%. AHG has actually increased in value by 29%. The Pendal Group has increased in value by 16%. Platinum Asset Management has increased in value by 23%. All in all, a good month on those stocks. You will see there that we've got a couple of securities that haven't performed well, but on average, our investment advice has been sound for this particular client. Now, let's now take a look at what happens after 3 months. So now let's look at a 3-month view on this portfolio. After 3 months, this is where the stocks stand. Ainsworth actually increased in value over the 3 months by 6.1%. Automotive Holdings Group actually increased by 55%. Pendal Group increased in value by 15.91%, and Platinum Asset Management increased in value by 22.42%. So across the board, we've got a client who's reasonably happy with the investment decisions that we've made, but probably more importantly, and what's most valuable to us, is to now give consideration to whether we should be selling any of these securities or not, remembering that for most retirees that are in super or in pension mode, the capital gains tax consequence for your holdings, if you are looking at superannuation investments, is either 0 or very small. Under an accumulation fund, your capital gains tax liability is going to be 10%, and the income, if you earn income, if you're trading securities, then what you find is the income's only taxed at 15%. However, if you're in pension mode, you will not be paying any tax at all, and so there's no barrier to what you choose to do in terms of buying and selling securities. So in this instance, I can tell you that our advice would have been to sell Automotive Holdings Group, because the uplift to fair value on Automotive Holding Group was 60%, and we've already made 55%. So we're going to get out of that. With Platinum Asset Management, it's sort of halfway to where we expect it should be, so we sort of expect an uplift of 40 to 45% on that. So we're going to hold the course there. We're still going to keep Ainsworth because it's got a little bit further to go to get to its fair value. Obviously, with Pendal Group, it's sort of a third of the way along its journey to get into the 48%. So very happy with Automotive Holdings Group. Reasonable for us to expect that the investment time frame over which our investment decisions will reach fair value is probably a little bit more than 3 months. So thanks Automotive Holdings Group for your performance. We'll probably make some changes there, but this is how we do what we do. What you're seeing and what we've just demonstrated to you is a method of investing money whereby we identify what fair value is for investments, and then we buy stocks that have got nice uplift to fair value. We actually monitor things on a daily basis, but we actually have internal operations that report things on a weekly basis, and we report to our clients on a monthly basis. But here's the thing, if you are investing money yourself, it's important that you make a commitment to managing your money properly before you jump in boots and all. We've seen many instances where we've had clients that have come to us, asked us to build a portfolio or a recommended investments, and then to cut costs or to save money, they've made the decision to do everything themselves, which is fine. We're really happy with that. However, it is worth noting that quite a few of these people come back to us and they say, I bought the investments that you recommended, but everything, like, we've lost money on them. And if a portfolio is designed based on fair value principles, for example, if we just take up Automotive Holdings Group, like, we're making decisions to buy securities, but once you're in the market, the only thing that's relevant is when you get out. And if you don't have expertise in analysing, or you're not prepared to make the time commitment or focus on monitoring how your investments are going relative to the returns that you're trying to achieve, you've got to ask whether you're acting in your own best interests or not. And so my advice to investors is, if you are one of the DIY investors, then make sure that you understand what your investment obligations and responsibilities are to yourself and to your family. And if you can fulfill those obligations, then outstanding, go for gold. If, however, you're not in a position to be able to commit the time, or you just don't have the interest, then it may be worth getting some professional guidance in terms of building your investment portfolio. For this particular client that we've made or use as an example, they actually they've made a return of over 21% on their listed portfolio over 3 months. So this is over a 3-month period of time. Their net performance after fees is 18%. This particular investment portfolio has a performance bonus on it. What that means is that the client's investment portfolio is designed so that the investment consultants and the asset consultants are actually paid a performance bonus if they achieve a return above the benchmark that the client has set. And the client's benchmark was not 20%, it was closer to 10%. And so the client's delighted because they've made more than 10%. The investment team are delighted because they're getting paid a bonus. And the other thing that's important to us is whether the investments that are being made are performing well relative to benchmarks. So you can see that at the bottom of this table, we have the All Ordinaries Accumulation Index, which achieved a 9.51% return over the 3-month period that we're looking at here, and that is a little bit under 50% of what the client's gross portfolio earnings were. So we're happy with what our investment team have done. We think they've made wise decisions in terms of buying and selling different securities over the last 3 months for the client, and the client's happy with their returns. Interestingly, over the same period of time, the growth index, which is the average of all of the growth funds in the market, achieved 7.62%, and the balanced index, which is the average of all of the balanced investment funds in the market, achieved a 6.17% return. So give consideration to what you want to do. If you have the time and the inclination and the desire to build your own portfolio, then there's a couple of different ways of doing that, but one way is to use fair value principles and methodologies and look to buy securities that are cheap and then naturally sell out of them when they get closer to fair value or they exceed fair value. My tip would be that you don't want to hold things for too long after they've gone over what professional research consultants or analysts suggest is fair value. One other tip that I would make is that you also need to review regularly what the fair value price is, because things do change in value. You will find that the fair value of a company or a property actually changes with time as well. Just in winding up, I think the most important thing to remember is that if you are going to make investment decisions of your own, make sure that you've got good research, make sure that you've got good systems and processes and procedures in place, and make sure that as soon as you make the decision to invest the money, that you are prepared to look after and monitor your investment portfolio regularly over time to make sure that you're getting the right returns. And if at any time you are in a position where you can't do that because something happens in your life, there are many good stockbrokers, financial planners, investment consultants who would be happy to give you help to look after things if you need help. Personally, we at Retirement Services Australia would be very happy to give any of you direction and assistance with your investment strategies if that's what you need. We're also happy to review what you currently have and tell you whether it's good, bad or indifferent, and where required we can point you in the right direction. Thank you for your time. Have a great day.